Um, Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the The intermeeting data on inflation and the labor market came in stronger than expected. And really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused as always on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So,
do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular, our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SCP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates. And then this latter part, kind of the possibility of credit conditions tightening really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning, we sat down and said, let's do this. And he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell, Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation has been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector. And that is, that's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet. And that's of course, 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina.
Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit. I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear to your last question. It's clear that we do need to strengthen supervision and regulation. And I assume that, there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
And the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we've well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong. It is sound. It is resilient. It's well capitalized, and I really don't see that as at all analogous to this.
Question: would you be open to an independent investigation separate from the Fed's probe?
I welcome that. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome when a bank fails, there are investigations, and of course we welcome that.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky. So do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I can follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic. And then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right. We have a little more flexibility under Section 13.3. We've done quite a lot under discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
Absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So, so people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer term securities. Large scale purchases of long term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless, what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors?
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb. Thank you, Chair Powell. Greg Robb from Market Watch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. But we, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well. And I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And I mean, there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, and because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation. And we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean. Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, particularly immediate attention. And I guess there were 6 of them. So
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
that is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. What can we do to make sure? But again, that's not for me to answer today.
Do you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, this review is going on, and I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, and so that's all I have to say. So, thank you very much.
All right, so that was his report. It looks like not a whole lot of new stuff happened during that report. First, I want to shout out to my supporters. Thank you, guys. Hey, listen, I really, really appreciate you guys coming through and supporting a brother. As you guys know, being a YouTube creator is there's a lot of stuff that goes into it, and you're never quite sure if your information is being well received. You think you're doing a good job, but you just don't know. And to have brothers that come through, like the Real Bravado Network, that come through and support a brother with $10. Hey, listen, you look. Thank you, brother. Thank you. He is in the men-centric field, manosphere. Great content creator. He his channel is growing, and he shows support for brothers. He go out to the Real Bravado Network. In fact, I'm going to link his YouTube channel at the end of the show in the description, so that you can support him. Full-time, working in a high stress, high power job, family man, just a great all around guy. Real Bravado Network. Thank you. Salute, brother. My man here, Kevin Brooks. Now, you want to talk about a brother that is funny, flat out funny, great sense of humor. Another YouTube creator. I'm going to link his show to the description. I remember he's in part of the lead attorney mastermind. And I remember that, we have, as part of the mastermind, you have the opportunity to show and have a part of your work, part of your in this particular case, it was a short evaluated by people in the group. So there are 40 people or so in the mastermind this particular night, and and it's a very stressful situation. You're brand new to the YouTube, or you're newer. You want to get evaluated with people among your peers, and you just don't know how it's going to go. So we're there, and it's toward the end of the night, and the lead said, "Hey, listen, does anyone want to have any piece of their work evaluated?" And Kevin Brooks, he raised his hand and said, "Hey, yeah, I have something. I have a short." He put that short on, guys. Look, that thing at the end was so funny. It was just too funny. No one knew where it was coming from. It had a great ending. It was funny. Congratulations, brother. Congratulations. And, I want to, again, thank you for coming by. Thank you for showing support. I am going to link your channel in my description also. And then lastly, the Do Better podcast with Theo Coop. Look, when you think about how podcasts and how YouTube channels grow, it's a progression. You get a couple of hundred people, subscribers, and then you get 1,000. You become monetized, and you kind of gradually progress up the ladder. And most of it takes half a year to kind of get through that. This brother started a channel, and within seemed like overnight 30,000 subscribers. And when you go to his channel, you can see that he is putting in work. Not only does he stream just about every day, but the quality of the content that he puts out, the topics that he do. He's also in the manosphere, but he is a solid content creator and funny. And that voice, man, he has the voice. I wish I had his voice. Thank you for showing support. Thank you for coming by with your super chat. I'm going to link your channel in my description. Again, salute, brother, and thank you for coming by. All right, so let's get to what Powell said. I'm going to kind of add a couple things to the stream here so that we can kind of take a look at where we are. Now, one thing that we want to point out is how his report affects investors. This is an investor channel. And so you hear a lot of things that he talked about that really covers someone who is investing in the stock market, or some of his comments were for the bank. Some of his comments was maybe for legislators. But I want to look at his comments as it's for us, let me pull it up here, the investors. Okay, so I wrote a couple of notes here. I'm going to pull them on up, and we're going to look at how this particular report affects us, the investors. First, the big thing, and this has been something that the Fed chair has been laser focused on for toward the end of last year. Really, he really started talking about the 2% inflation rate right around that third quarter last year. He came out, he announced that we're going to get down to this 2%. We're getting down to this 2% inflation rate, and he has not backed off of it. He really hasn't. Now, starting last year, he was super aggressive in what he would do, what the Fed would do to get to that 2% goal. He raised rates, and in many cases, many people are thinking that he raised rates the Fed raised rates at a rate that was not sustainable. It was too fast. It was historically too fast, and that could have caused, and that may have contributed toward the banking crisis. But I'm going to cover that a little bit later on in this report. But let's say that their goal of 2% inflation has not changed. How they get there may have. Okay, so I'm going to cover that a little bit more later on, but they're still looking for their 2% inflation rate, getting the inflation down to their 2% goal. They're not backing away from it. He talked about unemployment. He said unemployment is still strong. And they still want to get to, again, they say that the unemployment may have to, soften a little bit or adjust a little bit to get that 2% goal. I'm going to talk about that a little bit. Inflation kind of toward their 2% goal is still too high. Now, what a lot of people did not or expected to do was for them to come out and have raise the rate by 25 basis points or 0.25%. They have been raising at a rate of 50 basis points to 75 basis points prior to this particular raising. And a lot of analysts thought that it would either be 0 or 25 basis points. So they raised it 25. That was kind of baked into the rates. And we actually may see the rates go down because they came out and it was expected that they would do anywhere between a flat 0, not raising at all, to 25 basis points. And I do kind of expect a softening of the rate a little bit because of that being expected. Backing off of ongoing rate hikes. Now, he did signal that they're going to look at in future reports to us, the public, and to Congress and whoever. He may go out to the Brookings Institute and give a speech again. But he did signal that they're going to soften this super advanced, over the top rates that they've been doing historically. They're not going to be, I don't think that we're going to see any 50 basis points to 75 basis point. If anything, we're going to see probably a couple of 0 to, again, maybe 0.25 basis points. So he did say that, the Fed is not going to be raising the interest rate at the rate that they've historically has. And I think that reason why they are doing that is because of the bank failure. He did downplay their role in the bank failure, but quite frankly, guys, this is what's going on. In a nutshell, and again, this is primarily for investors. And so I may do another show that really dives deep into what happened with the SVB. But basically, Silicon Valley Bank is a bank for investors or startups, and the that bank itself bought treasury bonds, and as the interest rate increase, your value of your bonds go down. Okay, so think about this: you go out and you buy an asset. Let's just, again, I don't want to get too deep into the weeds here, but you go out and you buy an asset from the U.S. government. You know, and you expect a certain yield on it, and you think that it's a good bet. You're pretty bullish. Maybe you bought too much, maybe you didn't, and then here comes the Fed raising the rate, and as they raise the interest rate, the value of what you bought goes down. Okay, so you're losing money. At the same time, you have a lot of startups and investors that are they are business people. You know, they are people that has payroll. They're not the majority of their clientele were startups, right? And what you do if you're a business person, well, first and 15th or however, whatever you do whatever frequency you pay your people, you have to make payroll. You might have to buy something. You may have to, you have marketing. You have everyday things that you have to do to run your business. So you need cash. You need your cash. It's not one of those situations where your cash is sitting there. That cash is working capital. And some of these larger companies, they may be regional players. They may be like Etsy and others. They were on, they have people that they had to pay because of maybe some type of a dealership arrangement, franchising arrangement, or you have another company that, there was a couple of healthcare companies. You had people, you had payroll. You had payroll you had to make, and the payroll that you made was based on what you had deposited, right? Your lines of credit, maybe cash on hand, those type of things. Well, they were using it. Okay. So they was dwindling down. These guys had the stock losing value, so they sold some of the stock. And this is what happened. Once they sold some of that stock, all of a sudden, red flags was all over the place. Investors of the bank, and there's been a couple of cases where that was shown that investors of the bank called their angel investors that invested in the startup, called there and say, hey, listen, pull your money out. These guys or sold some of these treasury notes and lost $1 billion. Something is going on. Start pulling your money out. And there was a run on a run on that bank. They said that over the weekend, a short period of time, 48 hours, 72 hours or so, the people in the bank, the customers pulled out over $40 billion. That was on one report. All of a sudden, they didn't have the liquidity to cover it. They flashed red. Treasury came in, took over. But let's go back and see what caused that. What caused that was the interest rates, and that was the main thing. If they didn't have to sell those bonds, then this could have been averted. Simple as that. And if the Fed wasn't hiking up this interest rate at such a elevated, historically high rate, historically fast, to get to that, again, back to their 2% inflation goal, then this may have been averted. Now, yes, some could say, and even the Fed Chairman Powell said that the managers, in fact, I wrote it down, said that the bank grew historically fast, and he said that that the bank managers didn't hedge their risk appropriately and so on, and that it could have been anything that kind of toppled them. So he downplayed their role in the banking crisis while acknowledging that maybe they had some played a small part because of the interest rate hikes and how that affect their notes. Okay. So at the same time, he was saying that they did support the bank bailout. And again, I'm going to have another show that talks about how, from an investor standpoint, how this was a good thing. You have some analysts I've heard say that, oh, it's a bank bailout, and government should not have stepped in to bail out the bank, quote unquote, and all of this. Now, FDIC insures all deposits up to $250,000. Now, what's unique about Silicon Valley Bank is that, again, as I stated, it is primarily a bank that loaned money to startup companies. And these startup businesses were basically small, medium businesses that hired people. They may have there was 3 businesses, larger businesses that had, one had $30 billion in the bank. Another one had 40 billion. And, these guys had significantly more money than 250K. If the Fed didn't come in and say that no matter what, amount you had in the bank, we will insure it so you don't lose your money, you would have had a ripple effect of business after business after business just defaulting, just closing, filing bankruptcy. The labor force would have been decimated. You would have had a mom, dad startup business working out of their garage, with no money. Friday they were working for this company, and then Saturday or Monday, the money is gone through no fault of their own. That's not fair to them. That's not fair to them. And so when I hear these pundits come on and say, the government should not have bailed these guys out, and they should not have no. Real people was affected by that. Real people. So absolutely, if you put your money in a bank and you use that money to make payroll, you use that money to continue to buy durable goods, to buy goods that are needed to grow your business, you're doing everything right. You put your money in the bank on a Friday, and Monday you have no money through no fault of your own, and these are large, $20 billion gone, and you expect that company to survive. No, government did exactly what they were supposed to do. AV, thank you, brother. Let's talk. Look, I am going to talk about SVB and what happened. I'm gonna loop all of the dots, and show you how what the government did, in my opinion, was the right thing by guaranteeing, no matter what amount that you had in the bank, guaranteeing it as, your money is still there. Don't panic. You can still employ your people that you're going to employ. AV, thank you for the $20. I have the bank overstepped their assessment risk. Well, AV, I may pull you up because I don't want to to go too much into the banking debacle. I'm going to have a whole nother show on that. But yes, there was some fault at the bank. The bank take risks, but the bank did not expect that the Fed, when they bought those bonds, the bank did not expect the Fed to increase the interest rates as quickly as it did. That was unforeseen. It was not. There was no precedent because of that. And so, yeah, they could have diversified a little bit more. They could have hedged their risk a little bit more. But there was no way that once they ran into a problem with liquidity, and they reached out to other banks to get more money, and everybody said no, and they was forced to sell them. There was no turning back from that. There was no turning back from that. So we're going to talk about that. We're gonna talk about that. We're gonna really kind of dive deep into it. But let's go back to Chairman Powell. Like I said, he supported the bailout. I think it was a good deal. He did think that the managers of SVB could have been a little bit more diversified. And I agree there. I agree. He had a question about commercial. One lady came up and says that, was there a problem with commercial? In a couple of months, as you guys know that follow commercial, there's some money is going to become due. There are, and I'm talking about commercial real estate. And he said that what happened with the banks, he didn't see how it tied into the commercial space, and he does not see any issues with the commercial banking. So that's good. Because, guys, again, if we have a ripple effects, what happens to the banks? The banks raise interest rates. And if they raise interest rates because of in what they perceive as elevated risk, we're not going to have money to buy that commercial property. We're not going to be able to renovate that property, get it ready. Let's talk about what happens when we buy property. When investors buy properties, we buy properties that are distressed. We buy properties that are, there's a situation. We don't buy at the top of the market. We buy properties where there's a situation where we can buy that property at a discount. Then we add value. So we're buying let's say we're buying a strip mall, and that strip mall is $5 million. Okay. Right now, we have one of my companies. We're doing a renovation of a strip mall, not 3 miles from here. And let's use that as an example. This is a smaller mall. Let's say it's worth $5 million. That person bought it at $3 million. Okay, so there's $2 million or so worth of hidden equity. Well, once you can realize that equity by getting tenants in there, and to get tenants in there, then what you want to do is you want to add value to that by renovating a suite. If you can bring in different asset classes. Let's say this particular one that we're working on is a beauty salon, but let's say that one of the suites that we're doing now, maybe a church. We may have another a person that may come in and have some type of food shop there, maybe a sub shop or something like that. You're building equity in that. Okay. And you're building a payroll. You have a residual income coming from that. You're adding value to that particular property. So you go to the bank and you say, hey bank, I'm going to buy this property. It's where I know on the books it's worth $5 million. I'm buying it at $3 million. Give me here's my payroll, my rent roll. And these guys I've already got contracts on these guys, and these guys are going to be generating this amount of income once I have the place fixed up. Okay, once I renovate the place. The bank says, oh yeah, sure. I'll give you that 3 million, you're going to come in with some initial equity, 25%. If you come that, I'll give you that, and I'll give you the renovation cost. So I'll give you 80%, 75, 80% of the value of the building. And then what I'll do is, you said that it'll take 300,000 to renovate it. Okay, so we'll cover that. We're good. If the bank tightening that, if the bank, and that's all most people have. You don't have, $1 million of equity or liquid. You're not sitting around with $1 million in the bank account. You get you guys together, you got your team together, you buy it. If the bank does not give you favorable interest rate, or if the bank is not going to give you that rehab money, then you're not going to be able to add the value of that. And what a lot of investors do, guys, is they would buy something. This is the 5-year plan. I'm going to give you guys gain. I'm going to give you some gain. What a lot of people do is they will find a strip mall or some type of commercial property like that, add value to it. 5 years, what they would do is either refinance the whole thing or sell it and get the equity that they built into it. It's called force value. Once you do that, you can use a 1031 exchange or some other vehicle to buy the next one. So you're constantly buying more and more larger and larger projects, larger and larger commercial property. So you start off with something small, you build equity in it, you sell it at a higher price, you use the funds from that 1031 exchange, use that to buy the next property. And you just constantly go up the ladder. You usually do that between 3 to 5 years. That's why your team can buy these larger and larger properties, because you have, over time, this may have been your third commercial property that you bought. You made some profit from each one of those, and then you didn't pay any taxes because you did a 1031 exchange. Okay. If the bank is not willing to give you credit, you cannot buy that property. And most people don't go into the property using their own money. We use other people's money. We use bank money. We use your hard money, which is the worst, not as great of a way to do it, but you use other people's money. So the bank being able to extend credit to you is crucial. It is crucial, and you must be able to do it. You must be able to get credit. You must be able to use other people's money. So when we're going back to Fed Chair Powell saying that he doesn't see any problem with commercial lending or the commercial sector moving forward, then that's great. Because earlier, Chairman Powell said that the housing market, if you remember, he said that the housing market is sticky, interest rates are too high, but mostly he's looking at residential. He was looking at the residential housing market. Now, the housing market as a whole is kind of stubbornly high. That is true. But residential housing is different from commercial multifamily housing. Residential, you're looking at 4 units or less. You're looking at single family, duplex, quadplex, those triplexes. For a commercial building, is anything over 4 units, so 5 units and above. So that commercial sector is still a viable sector, according to Chairman Powell, for investors. And that's good news for us. That is really good news for us. A couple of notes from his report. I found it interesting that one of there was a couple of people that asked some questions that basically was asking him to take blame for banking and what he needs to do in the future. One thing that he did say positively is that they are doing a report now. They're looking at what role they played, the Fed played in the SVB, what role they played in the bank crisis. And I want to use his words exactly. He said, with respect to banking, do not put words in my mouth. The depositors are safe. I support the deposits. but don't put words into my mouth. Again, he was not trying to take any blame. Don't come for me. If he was a brother, he was saying, look, don't come for me. I am not going to take the blame for this. Yes, we raised the rates, but it's all on them. It's bad management by SVB. They should not have been as risky. They should have mitigated their risk, hedged their risk, and I'm not in it. I'm not in it. And then lastly, here's the big thing: is that there were one reporter came in and said, well, hey, are you going to cut in the future? I know you raised the basis points by 25, but are you going to cut rates? And he said, no. He said, yeah, it's going to do case by case basis. But we're not going to cut any rates in the near future. So for investors, what that means is that you need to, if you're doing single family homes, even all the way up to duplexes and quads, do not expect to have the rates to come down. So you're going to have to buy a property that has enough skin in the game so that you can still make your profit. You can still make your profit on the rates at hand. Do not expect the rates to come in. Now, one technique that a lot of people are doing and that you might want to consider for investors, and this is advanced game, guys, is that a lot of investors are taking part of their profit to buy down rates. You can do that. So if the rates are too high and you got a lot of skin in the game, a couple of ways you can do this. You can adjust the price, of course, if you have a lot of skin in the game, but then also you can use some of that profit or some of the skin to buy down that rate. And that's something that a lot of investors are doing so that they can move their properties. I think that if I was investing in residential, which I am, and I had a little bit of a skin in the game and I want to maintain my price, let me give you a scenario. You built a small, let's say you're building condos and it's a small, project. You got 12 units and you want to maintain the value of a particular properties. Most people, when they build a project, if it's smaller, they will build everything at one time. But then a lot of people, they will have pre-sales or different phases, right? And you have a property, you have, let's say you built your first 4 units out of the 12, and you want to sell it because you want to generate some cash. If you lower that price of any of those units, guess what? That becomes your new comp. So unit 1, 2, 3, and 4, let's say you want to sell it for $500,000 and you have a decent profit margin in there. Well, if you change the price of any one of those units, and when the appraiser come in and look at units, unit 8 that you're selling, unit 9 that you're selling, and they are exactly the same, well, now that new price that you lowered is now the comp for the active comp for all the other units. So you don't want to do that. That's why having changing the interest rate is better than, in some cases, is better than lowering the price. Because what you could do is say, hey, listen, I'm going to give you a discount on this. I'm going to maybe, throw in an amenity. I'm going to throw in I'm going to upgrade the kitchen to granite instead of high-end Formica. I'm going to give you stainless steel appliances, and I'm going to help you out by maybe giving you some moving expenses. I'll help cover some of the closing costs, and I'll buy down the rate to something that is affordable. I will do all those things before I change the price, because I do not want to have the new comp for that particular unit from $500,000 to $450,000, because all my other units that I'm building is now going to have that particular price. The new comp will be $450,000. So those are reasons why using these other techniques to lower the interest rate. The other techniques to make your home, your property more appealing would be better than just lowering the cost of it. Again, the Fed, there was nothing new, wasn't a whole lot of new information that was put out. Most of the things that he covered were we expected it. I'm going to see if the interest rate, if there's been any changes to the interest rate right now, but I would imagine that there will be some softening. Go to bankrate.com. There will be some softening in the interest rate because it was expected that Chairman Powell it would be somewhere around, let's see, it will be somewhere around the 0 to 25 basis points. I don't see anything yet. Okay, I don't see anything yet, but I will report on it as I get new information in. All right. Again, I want to thank the supporters that came in. AV, thank you, a great content creator. She is in the Lead Attorney Mastermind, an awesome YouTuber. Her show, her YouTube channel has been blowing up. She does legal matters, hot topics, just a great person. And guys, if you want to know anything about, she's going to be a lawyer, guys. She is going to be a lawyer. And when I started my channel, I had a bunch of things going on. I had several business, all in the real estate space. I had a consulting practice. I had a real estate business. We actually taught a real estate school. We actually taught people how to get their real estate license. And I was confronted with, well, should I do this full-time, YouTube full-time or not? I joined the Lead Attorneys Mastermind with some of the other brothers here. And I decided that ultimately that I wanted to make YouTube as part of my overall offerings and not just focus solely on that. I did that in part because I'm going to tell you how it is. I didn't think that YouTube would be able to sustain my current lifestyle. I wanted to advise you guys. I wanted to put out information about how to build wealth. That was something that I was good at, but I didn't think YouTube was the answer. I really didn't. But seeing someone like AV, who, I mean, she's going to be a lawyer. She was working as with a high-end company, just high-powered individual, and growing her YouTube channel amidst all of that, leading our little group with collaborations, with deals that she's working on, with all the things that she's doing, and still in law school to become a lawyer. That is awesome. That is awesome. Great content creator. Awesome content creator. Friend to the channel. AV to the seventh power is someone that you definitely want to follow. Go to her station, follow her. Great content creator, and thank you. I want to thank you for the super chat. It means a lot. It really does. It really does. I appreciate you. Notorious Kevin Brooks. We talked about this brother. He funny. As I mentioned, he's going to be on the I'm going to link to his show, Do Better Podcast. Thank you again for coming by. I really appreciate you. Real Bravado Network. Thank you again. I really appreciate you, brother. I really appreciate you guys coming by. But AV is, it got you. She is the channel sponsor. I really appreciate you for coming by. We're going to have a full conversation about this SVB. We're going to talk about, the other two banks, that Signature Bank and the other bank that is on the brink, and how banks can come to rescue other banks without affecting us, the depositor or the taxpayer. I'm going to cover that all in detail in my next show. And again, just recapping what the Fed said, nothing too crazy. He did take some ownership, but not much, about what happened with the bank fallout. He did support the bailout by the government. The government did the right thing by saying that they will go above the insured limit to make sure that all of the depositors were made whole. It is not a traditional bailout because the executives, they're on their own, or the investors into the bank, they're not bailing those guys out. They're only bailing the depositors out. So again, nothing too crazy. I do feel that the market is going to like that, this particular report. I do think that we are going to see some reduced rate hikes in the future. We're not going to see 50 basis points, 75 basis point hikes anymore. If anything, we're going to probably see a couple of cycles where there's going to be no hike. And then depending on where that inflation rate is, they may raise the interest rate up 25 basis points to kind of still get to that 2% goal, but they're not going to be as aggressive as they were. So the Fed, while they didn't say that they were at fault for it, they are seeing that this extreme hiking of the interest rate so that they can lower the inflation and get to 2% was a little bit too extreme, and they're going to soften it. So guys, as always, I want you guys to take this into consideration. This is not any financial advice. Please consult your financial planners or anyone else on your team. Look for opportunities to where you can buy low, sell high. You are in a commercial space. You should be fine. Stay grinding, and salute. I'll see you guys the next time.